Hello, everyone, and welcome to what I'm going to try to do a series on short videos with burning questions. I know I was originally planning on doing one long video, but I just haven't sat down and organized it. So instead, what I'm going to try to do over the next week or so is do a quick video like this one with one single question discussed. And we can go from there. As always, please, if you like what you see, give me a thumbs up on YouTube. If you have questions, comments, concerns, you think this is total nonsense and want to push back and argue with me, please be my guest. Email me constructive criticism, call the office on the phone, stop by. Whatever works for you is good for us. So with that, I want to say thank you for watching. Today, we're going to cover one of the top burning questions I've gotten in the last couple of months, and that is, why is today not like 2008? A lot of folks have said to me, oh my gosh, this is just like 2008. And I said, that's nonsense. This looks nothing like 2008. The magnitude of the decline in the stock market is not the only indicator of prior periods. Just because the market's down, let's say in the first half of the year, we're down roughly 21%, 22% on the S&P, 35-ish% on the NASDAQ. There's a whole host of other things. Just because a market goes down doesn't mean it's 2008. That's like post 1987, the crash. Anytime the stock market had a horrible Friday, like I remember October of 1989, all the weekend articles are about, oh, Monday's gonna be a crash again. It's nonsense. There has to be other things besides just price action. So let's do this. First, let's talk about the fundamental differences quickly between 08 and today. Well, big one is today we have the I word. That's inflation. We all know about inflation. We're living at the pump. We're living at the grocery store. It frankly stinks. 2008, oil went up into July of 08, but everything else was collapsing well before that. In 2008, you had the D word, which is deflation. And I've said this is probably since the early 90s. Inflation's easy to fix. You just keep raising rates and raising rates and raising rates, and eventually people will find substitutes and they'll stop. So in 08, what did people do? They stopped driving. It was the lowest miles driven since like 1980. Instead of buying stuff that had one ingredient in it, they changed and bought something else. The same thing is going to happen now. But more importantly, so we know that 08 was about deflation. This year's about inflation. Let me share my screen, which I love to do. And let's first talk about, where did people go in 08? Well, so here are Treasury bonds. And here is 2008. Okay. What happened in 2008? Well, until Lehman, Treasury bonds were certainly firm and generally trending higher, but volatile, I will give you. And then Lehman started to happen, and we saw this enormous Treasury bond run of 11, 12%. And then to end the year, Treasury bonds went even further stupidly higher. So you can see in 08, Treasury bonds soared. Today, well, with inflation, we see that Treasury bonds have completely collapsed. So there's one fundamental difference. Treasury bonds collapsed today, and they soared in 08. Deflation versus inflation. Let's look further. One of my favorites, places to hide, is the Japanese yen. Well, in the last year and a half, the Japanese yen, as you can see, has completely and utterly, this is the futures. Let me pull up the ETF. Maybe we'll get some better information. Yeah, now you can see numbers. So you can see the Japanese yen today, last 18 months, has gone from way up on top to way down below. I mean, it's been utter and cataclysmic collapse in the yen. We don't talk about why the Japanese yen is collapsing. The only thing I'll say, not to get wonky with you guys, is the Japanese government essentially decided they were going to defend and support and manipulate their bond market at the expense of their currency. A topic for a different day. Let's go back to 2008. Guess what happened in 2008? The Japanese yen, for the most part, rallied all year and rallied in big size too. So again, deflation versus inflation. People ran for bonds, they ran for the yen in 2008. Today, they threw them out at a rate which I don't think we've ever seen before. So there's two major fundamental differences in the landscape. I also want to make one other comment and share my screen and say that in 2008, heading into 2008, you could see down here, the personal savings rate was essentially at the lowest levels of, now let's call it 3%. And heading into 2008, the country didn't have any money saved, because if you remember, prior to the real estate debacle and collapse, people were living on credit cards and home equity lines of credit. It was something like the average American was spending $1.06 for every dollar they earned. And that went on for years. Eventually, when you run out of borrowing capacity, you're in trouble. So going into 2008, Americans had no savings, no cushion. Now, so the savings rate obviously was pretty poor. It spiked in early 2008 and slowly trended higher, but there was no savings to fall back on when the economy collapsed. Now, fast forward to the pandemic, we know that in early 2020, people hunkered down. Now, they had to, but also they weren't spending money on commuting and vacations and dry cleaning and dining out, fun stuff. So in April of 2020, the savings rate went to 34%. 34% savings rate in April 2020 versus 3% in 2008. Now, before you queue up your email and say, but, it's not 2020, it's 2022. Yes, I agree with you. The difference is that April of 2020 savings rate of almost 34%, and you'll see it came down to 13% and then back to 26%. Over a period of roughly 18, 20 months, consumers saved an insane amount of money. At one point, and I think it was to close the year of 2021, there was 2.5 trillion with a T, $1 trillion in excess savings. That's savings that wasn't there before. So in 2008, we came into the crisis saving no money, and we had no money overall. Coming into 2022, we had $2.5 trillion in excess savings because of how much we saved over a 20-month period during the pandemic. But yes, I see we're down to a 5% savings rate, still much better than 2008, and we have all that savings from the pandemic. So again, that's your third difference between 2008 and 2022. I know people love to just simply pull up a chart, which I will do. People love to do this. They love to say, well, Paul, but look at the S&P 500. Yes, I know the S&P 500 is down 21-ish%. Let's go back in 2008. And here's 2008, which ended up being 56% with a topic for a different day. But just because markets go down doesn't mean the fundamental backdrop is the same. It's not. So I urge you, before you get so hopped up that this is 2008 all over again, there's so many fundamental this is not. Again, finally, 2008, what happened the second half of the year? Well, we know Bernanke and company woke up, got their head out of the sand and realized, oh, geez, folks, we do have a crisis. And in today's market, we know that the Jay Powell Fed are the main drivers of the crisis because they decided to be asleep at the switch in 2020 when I started pounding the table, they should raise rates slowly. And they waited and waited and waited and waited an extra 18 to 20 months. So very, very different times, although I get it. Price, to start your year down 20+% in equities and what, 11, 12% in bonds. This is the worst ever. You've seen the quotes. It's the worst start to the year since 1970. It's the longest and deepest bond market decline since records have been kept. I'm going to have a quick video on that shortly, but it's getting long in the tooth. I'm going to say, again, thank you. I appreciate you watching. Thank you. Email, call, stop by with any questions, comments, concerns, and I look forward to seeing you guys again super soon. I'll have updates throughout the week as I head to the land of heat and humidity on the East Coast of Florida. So again, thanks for watching and see you soon.